A very good morning to all of you students. My name is Devas Gupta, and today we will be having the discussion around the live revisionary classes on the topics of securitization and derivatives. So let's start with the topic of securitization. So what we are going to do is we are going to briefly cover and revise the concepts. We will also do some of the fresh questions, and then also we will do some of the MCQs. So, in terms of securitization, we started with a case study and we said that if, let's say, there is a borrower from the bank with the name of Mr. A, and that borrower has taken a home loan from the bank for 25 years, which is the higher period of time, and Mr. A promises to repay the principal part and also pay the interest part on the loan taken to the bank. So this is a normal arrangement in any of the loans. Now, if I see the balance sheet of a bank, the loan actually appears on the asset side, right? Because this is a loan given by the bank. And similarly, there will be other things in the balance sheet on the equity and the liability side. Whatever banks are accepting the deposits from the general public in the form of fixed deposit, in the form of recurring deposits, those all comes in the form of liability over there. Now, the point that we are trying to make here is that once the bank has advanced any loan, let's say to the tune of 50 crore or 100 crore, the bank will continue to earn the interest on that 100 crore, right? So bank will earn, let's say 9% is the interest income on this 100 crore. And on the liabilities, whatever bank have accepted, it has to pay the interest. So let's say the interest is paid at the rate of 8% on this entire 100 crore. Let's assume that whatever the bank has borrowed, entire amount has been lent further. So this 100 crore, on this 100 crore, bank's earning potential is limited to 1%. But the bank is in the business of borrowing and lending the funds, right? By doing so, the bank's earning potential is limited. Now here, what will bank do? Bank will actually take this illiquid asset. Why we are calling this home loan as an illiquid asset? Because the cycle of realization of this asset is long term in nature, which is 25 years. And hence, this is an illiquid asset. So what bank will do? Bank will take this illiquid asset. It will sell the illiquid asset. That means it will sell the home loan that bank has given, and it will realize the funds. After realizing the funds, the bank will again lend such funds to generate more interest income, because the bank is specialized into giving loans, and hence the for the same corpus of money, the bank will keep on rotating the money and end up giving multiple times of loan, and hence the overall interest earning potential of the bank will increase. Now here in this case, Mr. A and bank, again the same example, the loan has been taken from bank, and again Mr. A promises to pay the interest and principal. And we also discussed that what is a loan? Loan is basically a right to receive interest and principal repayments. This is from the point of view of bank. Correct? That's how the bank will say that I have a right to receive the interest and principal. Now, how in effect these transactions take place? Because bank has already given the loan to thousands of borrowers, right? So it will collectively take them as one kitty, right? So bank will see them, all of them, as a illiquid assets, mortgage loans. Why we are calling them mortgage loans? Because the home loans, there is a mortgage created against the asset, that is the property. So this thousand of the borrowers, the collective amount will be taken, and it will be sold to a SPV, special purpose vehicle, which is floated to accept these liquid assets in the form of loans and pay the 1,000 crore today to the bank. So what will happen? Bank will transfer the right to receive the interest and principal to SPV, and SPV will pay off today 1000 crore to the bank. And what will SPV will do? SPV will fund this payment of 1000 crore by issuing securities to some of the pension funds where there is excess amount that can be invested. Some of the mutual funds, again, where there is an excess amount which can be invested. Banks, institutional investors, and high net worth individuals. So, wherever or with whomsoever who's looking around the possibility to invest into a business, from there, the amounts will be taken, the securities will be issued by SPV. They will subscribe to those securities, the amount will be taken by the SPV, and then SPV will pay the 1000 crore to the bank. And then bank, what it does, it will transfer the right to receive the principal and interest to SPV students. I hope this is clear till now. So with this, ultimately now borrowers, the borrower's position remains same. There is nothing. They have borrowed and they will continue to repay the principal and interest. Correct? But for the bank, the position changes because for the bank, the transfer of the loan has happened to SPV. And if we talk about SPV, then SPV has also structured this transaction by taking the securities proceeds from these institutions. Right now, this in entire process, what has happened, students? In this entire process, the illiquid asset, which is actually the pool of funds of the mortgage loans, got converted into marketable securities. Okay, these got converted into marketable securities, and these are multiple people who are actually investing through these marketable securities. This process is called as securitization process because you have converted an asset, an illiquid asset, to different levels of securities, and hence the name of the process, securitization process. Then there are two types of security, students. One, there is mortgage backed securities. Second, there is asset backed securities. So mortgage backed securities are the one where the underlying is the mortgage loan. For example, the home loan. Asset backed securities are the one where the underlying is other than mortgage, any other asset. For example, the automobile loan. In the automobile loan, the mortgage is created for the hypothecation is created for the vehicle, or there can be other receivable. For example, any credit card receivable. So these are called as asset-backed securities. Now, let's introduce the different terminologies to these arrangement. Originator is called as the bank who is actually originating the transaction. Borrower is the one who has borrowed the amounts from originator, right? The different types of home loans. And SPV is the special purpose vehicle that is created for the purpose of executing the entire securitization. Now, in this example, there are 1000 borrowers, let's assume, with 1 crore each of the borrowing that they have done. So this comes as 1000 crore. Now, there is a 20% probability of default, that out of this 1000 crore, 20% of the people might default, and the extent of default would be on an average 50%. So can we calculate that what is the defaulted amount? Yes, on 1000 crore into 20% into 50%. So it comes out to 100 crore. So this 100 crore is the risk, correct? Is the risk that the originator will not be able to accept, or let's say collect. So what will SPV will do? SPV will actually look into this and it will enter into two types of arrangement. There are two possibilities. One, on recourse basis. Second, on non-recourse basis. So the one on recourse basis, it actually allows SPV to get funds from the originator in case the borrower defaults. So in case this 100 crore is defaulted by the borrower, the SPV will have a right to claim back the funds from originator. That is called as recourse. In case of non-recourse, there is no entitlement to the funds from originator in case the borrower defaults. So that means the loss will remain with SPV in case of a non-recourse. In case of a recourse, the loss of SPV will be made good by originator, and hence the originator will bear the loss. Clear? Then let's introduce some more parties to this arrangement. We have discussed about the originator, we have discussed about the borrower, we have discussed about the SPV, and we have also discussed about the investors into this SPV by the form of provident fund, by the form of pension funds and other people who want to invest, right? Now, if I introduce other parties, now once the borrower is actually supposed to repay the amount on the home loan, it will do through a receiving and paying agent, students. Receiving and paying agents are those whose responsibility is to collect the amounts from the borrower and remit it back to the SPV. Clear? Because now the SPV will be responsible for collecting the amounts. And SPV actually is held in the form of a trust, because the money is kept in the form of a trust. Then obviously there is a credit rating agency whose responsibility is to do the credit rating of this securities that are being issued here. For these securities, the credit rating is done, because if they carry a good credit rating, the investors' confidence will also increase and they will be able to do the subscription to these uh, securities properly. Okay. Then, in terms of the credit rating, if it is good, then the lower the risk, lower the return. If the credit rating is not good, higher the risk, higher the return will be expected by the investors, students. I hope this principle is clear. Okay. Then the next point here is around the different securitization instruments. Now we discussed that securitization is a process of converting illiquid assets into the marketable securities. Now, what are the different kinds of those marketable securities is what we are talking about here. So the first one is actually the pass-through certificates. As the name suggests, pass-through. Whatever comes in goes out. So that is called as pass-through. Pay-through securities. This is another form of securities wherein that means the securities are independent to the cash flows of the trust. Whatever has been committed on the securities will be paid or settled separately to what the trust is receiving as the cash flow. Then the third one is actually the stripped securities. Now, in this, we are talking about the leg of SPV to investors, students, where SPV is issuing securities to the investor. We are talking about that leg. Okay, this entire three different kinds of instruments. Now, let's talk about, if I list here, if there is a security of debt, what is the underlying financial metrics that is used to value those debt? For example, in case of debt, it will be interest rate. In case of an equity, there will be earning or dividend. Correct? So the earnings, the higher the earnings, higher the equity value, higher the dividend. Obviously, the equity value will be influenced by the dividend prices. So the business is actually the underlying of generation of the earnings. But here there is no fixed commitment. Similarly, mutual funds. Mutual funds is actually the NAV for the equity or debt, whatever is the case may be. Derivatives. We will study in the upcoming part on derivatives what is the underlying. Mortgage backed security or asset backed securities. In case of mortgage backed securities, it is mortgage loans. Asset backed securities, it is receivable. Any other receivable, right? Securitization related securities, the pool of funds or the illiquid assets. So these are all the underlying against which the normal transaction happens, right? Now let's talk about the first one, which is actually the pass-through certificate. As the name suggests, pass-through means it is actually passing through. So in case one, we are discussing that whenever there is a borrower and there is a SPV and there is an investor, right? So borrower actually pays 100 of principal and 50 of interest, and along with that 150 has been prepaid in the form of prepayments to the SPV. So where we end up receiving 300 rupees by the SPV. Now since this is a pass through certificate, whatever SPV is receiving, it will pay out to the investor. Clear? So it will proportionately pay 300 rupees to all the investors, and hence it is called as pass through. The second case within pass through certificate will be of, let's say, the borrower has paid to SPV 100 of principal and 50 of interest. So what will SPV will pay to the investor? 150 rupees proportionately it will pay to the investors. Case 3, if there is a default in payments. Let's say borrower actually pays to SPV and SPV to investor. So what does borrower do? Borrower actually instead of 100 pays only 80, and instead of 50 pays 0. So in totality, let's say the SPV receives 80 rupees. So what will SPV will do? SPV will pay 80 rupees to the investor, and hence it will be proportionately paid to the investor, right? So in case of higher receive, in case of lower receive, in case of same receiving, the SPV will pay to the investor on a proportionately basis. For investors, proportionate share in cash flows of SPV, that is called as pass-through certificates. Cash flows of investor would be linked to the cash flows of mortgage loan held by the SPV. Now, pay through securities, students. Now, pay through securities is somewhat independent to the cash flows of the borrower and the SPV. Now, the way it will work is, let's say there is an agreement between SPV and investor that 200 will be a guaranteed cash flow to the investor. Okay. Now, the way it happens is the borrower will actually pay whatever amount that they want to pay to the SPV. So that is, let's say, 100 of principal, 50 of interest, and 150 of prepayment. Correct? So that means essentially they will end up paying 300 rupees to SPV. But since SPV has committed only 200 rupees to the investor, so SPV will pay 200 rupees to the investor. And balance 100 rupees, it will invest in some other part of the business. Clear? Now case 2, let's say borrower receives 150, borrower pays 150 to SPV. So this 200 rupees that has to be paid as a guaranteed amount will still be paid. Although SPV have received lower, so this 50 rupees of shortfall will be utilized from this earlier investment of 100 rupees. And hence it will be paid as 200 rupees to the investor, students. The third case, in case of zero default, in case of entire amount being defaulted, the borrower pays nothing to SPV. SPV still need to pay 200 rupees to the investor. So what will SPV will do? SPV will take 50 rupees of the earlier investment that was left, correct? We started with 100 rupees overall investment. Out of that, 50 rupees got invested. Balance 50 rupees will be utilized here, and balance 150 rupees will be taken as a fresh borrowing, students, and it will be paid to the investors. So what is happening here? The cash flows of the security and the cash flows of the SPVs are totally delinked. Okay. And sometimes we also call as that this is a pass-through entity. Pass-through entity means that entity A is actually acting through entity B to entity C, right? So it's a pass-through. That means there is nothing significant that that entity is doing apart from holding the investment in and investment out. Cash flows of the investor is not linked directly to the cash flows of the mortgage loan held by SPV. So this is called as pay-through securities. Surplus can be invested and shortfall can be borrowed. Pay-through security is separate identity from that of the mortgage loan. This is very clear. Then pass-through certificate also is the same identity as that of the mortgage loan. Now, in case of pay through securities, their total desynchronization when it comes to the cash flows to be paid to the investors and cash flows to be received from the assets. So both of them are independently viewed. So past
Sir, an issue? Sir, an issue?
there was a significant amount. But yeah, so what I was talking is that for pay through securities, there is a complete desynchronization between the cash flows that are paid to the investors and cash flows that are received from the assets. Hence, we can draw out the difference between the pass-through certificates and pay-through securities. Pass-through certificates, there is no stability in terms of the cash flows, right? Because whatever comes in, it goes out. And hence, there can be some spikes that can be expected in the way the cash flows are there. But for pay-through securities, the stable cash flows are there because whatever is committed will be paid off. Now let's come to the third type of security, students, which is around the stripped securities. So stripped securities are the ones where, so stripping means creating different tranches, creating different types. So stripped securities means that we are stripping off the two components in a cash flow. One is the principal amount and second one is the interest amount. So if let's say this 100 of principal and 50 of interest are being split, right? So one will be called as principal only securities and second will be called as interest only securities. And there is 1,000 security, 1 crore each. All of them will get splitted into principal only and interest only. Now, whatever security has been subscribed for, whether principal only or interest only, the cash flows will also be related to that. So SPV is going to sell IO and PO separately, which is interest only and principal only security separately in the market. What is this SPV going to do? In case of interest only, the investors and principal only investors. So initially, if let's say the interest rate is 10%, the interest only security is valued at 50. The principal only security is valued at 100, for example. Now, if the market interest rate actually increases to 12%, it means what? The interest only security, the value will increase. Reason being, 50 was equivalent to 10%. Now, effectively, 12% would be equal to 60. Similarly, for the principal only securities, for 10%, there is 100 rupees. Correct? At 12%, the value will decrease because principal. So, as we know that interest rate is inversely proportionate to the bond prices, right? And this principal only security is as good as a bond. So, it will also go down. So, that means it has inverse relationship. So if the interest rate goes up, bond prices goes down, interest rate goes down, bond prices goes up. That's the phenomena that we know, right? Now, extending the same example, 10%, 50 and 100. Now, if let's say the market interest rate goes down, in that case, the interest only security value will also be going down, but the principal only value will be going up because on 100 rupees, the 10% equivalent was there, which will now be equated to 8% value, which is going to be 125 rupees, right? So this is, I think, the capital asset pricing model. Cost of equity is equal to risk-free rate of return plus beta, and the market premium, correct? And here also we say that the market price is always inversely proportionate to the cost of equity. Higher the cost of equity, lower the price. Lower the cost of equity, higher the price. So pass-through certificate students, now let's talk about how the mathematic works. Now in case of a principal of 100, 200 and 200 rupees, let's say there are three different types of principals. Okay, there are three different types of mortgages, mortgage 1, 2 and 3. There are different types of the interest rates and there are different maturities. So what will happen for this total 500 crore, SPV will receive 500 crore from the investors by selling this. Now, weighted average mortgage rate will be what? 5, 5.5, and 6. So, this is 5, 5.5, and 6. Right? So, in totality, they will be getting 5.6% as the income of SPV. Correct? That's the gross interest that they will be receiving. And minus 0.6 can be assumed, let's say, to be their operational expenses that the SPV will be doing. So this balance 5% now is available for distribution, which is called as the net pass-through rate. Clear? Now, if we talk about what is going to be the weighted average maturity for this, so we will take all the loans, we will also take their maturities, and we will arrive at the weighted average maturity. So SPV will propose to the investor a return of 5% for 1.2 years for all these three mortgages as underlying. Okay, hope this is clear, students. Now, the next topic is around the features of securitization. Now, the features of securitization is actually the characteristics of securitization, that what this process is overall doing. One, it helps in the creation of the financial instrument documents, right? What are the financial instruments involved here? Definitely the securities that are getting created. Pass-through certificates, pay-through securities, and the stripped securities. These are the three different types of securities that we have studied. Second is around the bundling and unbundling. So bundling means that we are putting together all the mortgages in one pool. Unbundling means we are giving the different kinds of securities. We are issuing the different kinds of securities to the investors. Third, it also acts as a tool of risk management because the risk is being shifted, although it is a recourse or on a non-recourse basis, it will depend. But the banks are in a position to do this with the SPVs. Structured finance, it is a form of a very structured financing. Trenching we will go through. So trenching means to create different classes of investments of the securities. Like in a company, you have debentures, you have preference shares, and you have equity shares, right? So that is called as trenching. That means you are putting different classes of the risk of the assets together. And homogeneity means that the process is actually leading to homogeneous issue of the securities. Now, who are the participants in this? There are almost all the participants that we have discussed. We can actually bifurcate them into primary participants and secondary participants. Primary are the ones who are actually originator, SPV, and the investors. These are the primary parties. The secondary participants are obligers, rating agencies, receiving and paying agents, trustees, credit enhancements, and the overall structurer, right? Now we have also discussed about some of the problems or issues or challenges in securitization. Some of them are stamp duty. Okay, because this is a security, it involves the payment of stamp duty whenever it is issued or whenever it is bought or sold. Second is around taxation. The taxation principles are also a bit complex around the securitization process. Third is around the accounting, whether the loans that are given by the bank and then it has been converted into a securitization process, whether they will appear onto the balance sheet of the bank or not, that will depend on the terms and conditions specified in the contract. Then there is a lack of standardization. Since there is no standardized method to do so, different companies resort to the different ways of working depending on how they want to do this. Then obviously there is an inadequate debt market and ineffective foreclosure laws. Foreclosure laws means that if I have to foreclose the loan, for example, the 1,000 borrowers, they foreclose the loan by paying it early, then how are we going to impact the entire securitization process? So as we discussed, students, trenching. So tranches means different levels of what? Senior, mezzanine, and junior. These are the three different levels. For example, preference shares, equity shares, and debentures for you to understand. So as I discussed already, company has equity shareholders for which there is a risk and reward, right? Preference shareholders, there is a medium risk and there is a fixed dividend. Debenture holders, there is a lowest risk and there is a fixed percentage, right? So the way these three different tranches are there, The SPV also creates different tranches. So the way SPV will say is that, okay, my first tranche is going to be senior, which is going to carry the highest amount of risk and return. Mezzanine will be, let's say, a medium kind of a risk and return, and junior can be a place where it will be very low level of risk and very low level of return. Then comes the blockchain concept, students. So blockchain means if you distribute this into two parts, one is block and second is chain. Block means collection of data, right? Block means collection of anything. So this is a collection of data. And chain means it is tied to another block. Then block 2 is tied with third, fourth, and so on. So there is a chain of the blocks, right? And these are accessible to million of the users. This is called as distributed ledger technologies. So imagine, students, that you are working on a shared Excel file, and lot of people who are having the access to the shared Excel file can amend the Excel file on a real time basis, and their changes will also be saved. So the users have the right to go through the data, to go through these blocks, add any block, right, to the existing chain, and hence this is called as blockchain. Now, for example, Indian company has to pay to an Australian company. So let's use this example to understand how in real life the blockchain technology is used. So the Indian company has to pay $100 to the Australian company. So what will happen here? So there is a block of data which will say that the Indian company has paid to the Australian company. The balance is $200. Pay $100. The balance will become $100. This will be visible to the Australian company and Indian company and even others. This will be broadcasted via the network, and it will be a cryptographically stored. It will be, the cryptography is applied to this, and it will be stored and extracted. So there will be a validation process to store it, to extract it, to review it. And this will be represented as a block added to the existing blockchain, and hence the transaction is complete. So with this, the information is that the Indian company has paid to the Australian company. Although the funds have never moved through the banking channels, right? So this is something that can be used, but legally and practically these things are now not permissible through the proper channels of the payment, because Reserve Bank of India, it has to be closed in terms of the documentation. Okay, so the next one is around the applications of blockchain. Now these are some of the applications which don't involve the payment or receiving of the money, but it is more so to manage the records, to manage the other things. So the first one is around the financial services. In case of financial services, the blockchains can be used. Similarly, in healthcare, for example, there is a patient for whom there is a medical history record. So those can be added to the different blockchains, and hence the overall thing can be used. Government, there are a lot of government departments. For example, the courts where the registration happens. So there also the chain of documents can be stored using the blockchain. Travel industry, when it comes to the travel documents such as passports, visas, etc., those can be actually linked through the blockchain technology. Any sort of economic forecast which involves huge amount of data, that can also be used in the form of a blockchain. Risk associated with the blockchain. So there is a member of network, right? There are different members of the network. It would be very difficult to fix a responsibility of any specific person. Then it's more about technology, right? Technology which is very hard coded on the background. There is a code that runs. Again, there is an absence of central authority, and we are talking about humongous data here, where the people from all around the world are actually going to change the stuff. So then in the next topic, let's also talk about tokenization, students. So tokenization is also very much similar to securitization. So it's a process of converting tangible and intangible assets into a blockchain tokens. Okay. So let's imagine that there is a intangible asset in the form of a art or craft or a beautiful painting, right? Now if that needs to be bought and sold in the physical market, again the access related issues remains. So what happens, that piece of art actually gets converted into blockchain tokens, and those can be bought or sold easily with the help of blockchain technology. Okay. Now, it is very much similar to the securitization process. How? It ensures liquidity, because if the transaction would have happened in the physical space, it would have been less liquid. Now, because the transaction is happening through tokenization, it injects liquidity within the market or within the process. Second, it's all about diversification, right? Because now with the tokenization, you can reach out, you can do the diversification piece, right, which would have not been possible in case you would have done through the physical form. Trading, it also helps the trading in the secondary market where the purchased tokens can be bought and sold further, and then also it opens up the new opportunities. Okay, so I think this was it, students, on the securitization topic. So overall, if I sum it up, securitization is a process of converting a liquid asset into the marketable securities through different forms and means. Okay. Now let's move to the derivatives, to the next topic of derivatives. What we are going to do is we are also going to do some of the questions and MCQs towards the later part of the session. But let's go through some of the concepts first. So we are coming to the second topic of today, which is the derivatives analysis and valuation. So derivative students, first of all, let's spend some time to understand what is meant by derivatives. And again, we are doing it on a revisionary aspect. In detail sessions, we would have covered the detailed topics of what it is actually leading to. So students, derivatives, as the name suggests, is something that it derives its value from. So if let's say A is deriving its value from B, so if A, sorry, just a second. Yes. So if A is deriving its value from B, or I can say A's value is dependent on B, so A is going to be called as a derivative and B is going to be called as an underlying. Underlying in what sense? Because this is the underlying on which A's value is dependent. Now, B, let's first talk about what can be different types of underlying. Now, the underlying can be in the form of a commodity, it can be in the form of an equity, right? It can be in the form of a foreign currency exchange. It can be in the form of even an index, which is Bombay Stock Exchange and National Stock Exchange in the India's context becomes the Sensex and Nifty. And then obviously weather, right? So these are some of the underlyings that are there in the form of a whether these underlyings are independently bought or sold or not, it doesn't make a difference, because for example index are not bought or sold on an independent basis. Similarly weather. So these are certain items which can act as an underlying for a derivative. Now let's talk about the A part here, right? Which is the derivative part. Now the derivatives, there are some basic features of the derivatives. There is a buyer and there is a seller. Buyer is responsible for buying the derivative, right? And seller is responsible for selling the derivative. Now, the point that we are trying to make here is that the A and B, the buyer and the seller of the derivative, will be different from the buyer and the seller of the underlying. For example, derivative X is buyer, Y is seller. For the underlying, M can be buyer and N can be seller. Clear? So effectively, we are saying that the buyer and seller of the derivative will be different than the buyer and the seller of the underlying. Then the value of derivative is dependent on the value of underlying. This is the principle on which derivative value is dependent, students, right? The next one is around the fixed tenure of the derivative. So always any derivative we talk about, it has to have a fixed tenure. For example, 1 month, 2 month, 3 month, or let's say 1 year or 2 year or whatever it may be. Then fourth is around the settlement. The settlement actually talks about the net payoffs from buyer to seller or net payoffs from seller to buyer, right? So this is what the settlement piece is. Because ultimately, once the maturity comes, it has to be settled. There are fixed and certain positions, and there are certain uncertain or variable positions in a derivative, right? What are the fixed things? The underlying is fixed. We are talking about only this as an underlying. The quantity of the underlying is also fixed. The quality of the underlying is also fixed, and the time period, students, right? So these are certain things which are fixed. What is uncertain? The uncertain is about the price, which keeps on changing, which is dependent on the value of the underlying. Now let's talk about the different types of derivatives, students. We will be talking about forward contracts, we will be talking about futures, we will be talking about options. So let's talk about forward contracts first. So this example we have discussed to take you through what is the basic concept of a forward contract looks like. So let's assume there is a procurement manager in a company, and that procurement manager is going to purchase a crude oil of grade A of 20 liters. So this is quality, this is quantity, right? And this is underlying. Underlying is crude oil, correct? Delivery after 6 months, time period from today. So all these conditions are satisfied, right? There is a time period, there is a quality specified, there is a quantity specified, and there is an underlying. Today's price is 100 rupees. After 6 months, price is likely to go up. So the procurement manager and the supplier, they are actually locking the price at 110 rupees per liter. And the supplier is going to supply 20 liters of grade A crude oil. Correct? So what they say that after 6 months, since the price is likely to go up, let's agree today only that the price is going to be 110. Okay. After 6 months, students, what happens? There can be different scenarios. The actual price comes out to 115. So the procurement manager will say that I have actually contracted with you to purchase at 110. The market price is 115. That means 5 rupees I will be gaining. Had I not entered into this contract, I would have purchased at 115 and I would have ended up paying 5 rupees extra. The negotiated price is 110. However, the supplier of the crude oil will say that I have taken a 5 rupees loss, because had I sold it in the open market, I would have realized 115 rupees. Correct? But now, because of this contract, I am realizing only 100 rupees. Similarly, if the actual price is 95 here, the actual price is 95 here, that means the procurement manager would have gone in the open market and purchased it at 95 instead of 110. But since there is a contract to purchase at 110, there is a 15 rupees loss that the procurement manager will have. On the other hand, supplier will be happy now because supplier will say, although the price in the market is 95, but both of us have agreed to take the deal at 110, and hence I will be able to sell my crude oil at 110, which is effectively 15 rupees gain. And in case, let's say the actual price is as good as 110, so that means there is no gain, no loss. Whatever is the forward contract that will get executed, students. I hope this is clear. Now let's talk about settlement of a forward contract. Now after 6 months, since this is about to take the deliveries and pay the amount, so procurement manager will pay 20 liters equivalent of 110, which is 2200 to supplier, and supplier will deliver 20 liters of crude oil to procurement manager. Since this is a forward contract, this is over the counter. That means it is customized and it is settled on gross basis. Second is around futures. So for futures, again, these are also financial instruments which are very much similar to the forward contracts. Only the difference here is that these are the standard contracts. You cannot change the contract terms and conditions. These are going to be standard. For example, the quality, the quantity, the lot size will all be defined and it will be standard. And these are always settled on net basis, students. That means there is a net payoff that happens for these. These are never settled on gross basis. And futures are always traded on a stock exchange. They're always traded on a stock exchange. Because they have to be traded on a stock exchange, they are very much consistent, they are very much standard. Now let's assume that there is an equity share of X Limited. In case 1, the prices are going to go up in the time to come. That's what we have a hypothesis that in the future the prices are going to go up. Now there are two things possible, right? One, either to buy the futures, and second, either to sell the futures. What I'm going to do, if I'm going to buy the futures, tomorrow if the price goes up, in our previous example, the procurement manager was in the position of buying futures and supplier was in the position of selling futures. Although here we were not talking about the future buying and selling, it was more about the forward, but I'm just still referring this example to say that the position of the procurement manager was to buy and supplier to sell. Now in this case, if the prices has gone up, who has benefited? The procurement manager has benefited. If the prices has gone down, the supplier have benefited. Right? The prices have gone down, the supplier have benefited. Now in this case, if the prices are going to go up in the future, what I'm going to do, I'm going to buy the future. I'm not going to sell the future. So if let's say today 100 is the opening today's price and 120 is where it gets. So what I will do, at 120 I will sell, 100 rupees I will buy. So net 20 rupees I have a gain here. Clear? Then for case 2, if price is expected to go down in time to come, if there is an expectation that the price is going to go down, then what I'm going to do, I'm going to sell the future. Right? Selling the future will mean that I am going to benefit once the price goes down. Then again, there are two different types, buying and selling. Buying means there is a long position, selling means there is a short position. Okay. So, what I'm going to do today, I'm going to sell at 120 rupees and I'm going to buy at 100 rupees after 30 days. This process is called as short selling. Short selling means I'm selling something that I don't have. So, is this short selling allowed in the underlying market, which is the cash market or spot market? The answer is no, because you cannot sell what you don't have. In the spot market or in the cash market, you will have to give a delivery of the share which you don't have. However, in case of futures and options, since the settlement is happening on a net basis, in futures, options we have not studied till now, but in futures, can you do the short selling? The answer is yes. In the underlying market, can you do long position, long position? The answer is yes. But short position is not allowed in intraday for cash market. Short selling is allowed for futures and options, but this intraday short selling can be done because within the same day you are going to sell first and then you are going to buy later. So in the same day you will be getting the delivery and you will be also delivering the share. So intraday it is allowed, but intraday short selling is not allowed. Okay. Then futures and underlying shares are totally dealing the buyer and seller, right? There are different sets of buyer and seller, and underlying also have a different sets of buyer and seller. Now, if we talk about cash segment, where the underlying actually resides, forwards we have also talked about that these are the over the counter, these are the customized contracts, and these happens to be on actual basis, the settlement, the gross basis. Futures are standardized contracts. These are traded on a stock exchange and it's actually settled net. I hope the topics and the differences between underlying forward and futures are clear, students. Clear? So, if we move ahead, let's also now talk about the pricing slash valuations. Now, pricing is actually taking some of the concepts from the compounding concepts. What do we mean by compounding? We know this easier formula, right? Where A is the future value, P is the present value, 1 plus R is the rate of return, and T is the time period, right? So, this is my compounding on a timely basis. Semi annual compounding means that compounding happens twice a year. So this is going to be 1 plus r by 2 raised to the power 2 multiplied by t. And t is going to be 1 year and r is equal to rate per annum rate. So a is equal to p 1 plus r by n raised to the power nt. So this is the discrete compounding where n actually refers to the number of compounding in a year. Number of times a compounding is happening in a year, right? Because let's say if compounding is happening 4 times in a year, so what we will do, the annual rate of return, this is the r per annum basis, we will divide it by 4, and the time which is always taken 1 for 1 year will also be multiplied by 4 students. So this R is actually 10%, time is actually 3 years, which is compounding quarterly, right? A is equal to P 1 plus 10 by 4 raised to the power 4 into 3. And if we talk about continuous compounding, students, continuous compounding is the place where the continuous compounding is the place where n is taken to infinity. That means the compounding is happening every now and then. So in this case, the formula actually revised to A is equal to P into e raised to the power R t, which is the continuous compounding. So A is equal to the future value, P is equal to the present value, R percentage per annum, time year, which is 1 year, and E is equal to the exponential function, right? So if we talk about continuous compounding, we always need to apply this formula if A is equal to P into e raised to the power R t. Valuation of forwards or futures. Now let's talk about how are these principles used in the valuation of a forwards or a future. Now these are, we are talking about the present value, which is the spot price, right? If we have to arrive at a future value as on today of this spot price or present value, what we are going to do, we are going to calculate the future value of the spot price. The price of the forward slash futures is equal to future value of the spot price. Simple. Whatever is going to be my forward or future value is the future value of the present value. So the expiry, we have to take the time period for calculating the future value. For example, expiry is 1 month. So we will be calculating the future value of 1 month. Now, again, students, we have discussed about discrete compounding and continuous compounding. In case we are given the facts around discrete compounding in the question, we will be applying this formula. In case we are given the facts around continuous compounding, we are going to apply this formula, which is the continuous compounding formula, right? Now, today, if there is a spot price of 100, right, there are different futures that will be running, or let's say forwards that will be there possible on that one spot price. 1 month can be, let's say, 101, 2 months can be 102, and 3 months can be 103. So effectively what it means, it means that higher the gap between the expiry of the future, higher will be the, or let's say the value will be different, because the future value will be dependent on the time to expire. Okay. Now there is some added complexity to the dividend and transaction cost. What are they? One, definitely there is a discrete dividend. There is a discrete dividend. That means that the dividend is expected to be paid. So the formula actually gets changed to P means spot price minus present value of dividend, which is actually the dividend that is going to be paid on the cash market, but dividends are never paid in the futures market. So hence we have to reduce the value of the spot price from the dividend that is expected to be paid. And always do remember, if let's say dividend is to be paid after 2 months, so what we are going to do, we are going to take the present value of the dividend now, and we are going to reduce it from the shares present value to arrive at the ex dividend price, and that we will be multiplying it with the compounding procedure of 1 plus r divided by n raised to the power t n. Clear? And hence A will be, in case of a transaction cost, we are going to add the present value of the transaction cost to the underlying, because to make it like to like and comparable, because transactions cost are always added to the base, right? Then, in case of continuous compounding, so everything remains same except for the fact that e raised to the power rt is taken as a factor instead of 1 plus r divided by n raised to the power tn. Clear? The next piece is in case we're talking about the continuous dividend, students. So the continuous dividend is the place where we are actually paying dividend on a continuous basis. We are not paying dividend on a discrete basis. Let's say the question can tell you that the dividend is paid at the rate 2% per annum continuously compounded. So in this case, the formula, the way it will work is e raised to the power r minus y in the power itself, because y is equal to the dividend yield that will be taken up to do the final compounding. And on expiry, the price of the futures is going to be the price of the spot. Okay, so this is how the continuous compounding will be there. Okay, then the next piece is the difference in the future price versus the spot price. This is called as the basis, right? So towards the expiry, it almost becomes negligible. It becomes zero, right? Because the time value of money becomes, the gap becomes smaller once the time period expires, right? So the future price will also go in tandem to the spot price on expiry. Now let's talk about, students, some of the uses of derivatives, where all these things can be used. So the first one is around speculation with a hope of gain and with a risk of loss. Hope of gain means what? That I am speculating that I will be able to gain through the price increases or a price decreases. Now we all know that even a price decrease can also help us gain through short selling. And the risk of loss is something that we are going to incur in case the position turns out to be opposite to what we have expected. Now let's talk about long position, students. Long positions and short positions, there are two positions that we discussed, right? Let's say 80 is the today's price and at the rate of 1000 of the futures I'm talking about. So the futures of X Limited is entered for 80,000 and the short position is also entered at the 80,000, because if some person is buying, the other person would be selling. Reality, what happens, there is a 20% margin that is kept against that 80,000, which is around, let's say, 16,000, which is deposited with the stock exchange on which we are going to deal. Now on expiry, what happens, students? On expiry, there can be different possibilities. Let's take couple of possibilities, one where the price is lower, one where the price is higher. Now if the price is lower, 70 rupees, the person who has taken a long position will lose, and the price is actually 90, which is higher, the person who has taken a long position will gain. So here there will be a gain of plus 10,000, here there will be a loss of minus 10,000, and 16,000 is already the margin that is there. So this 6,000 and 26,000 becomes the overall cash flow at the expiry. Clear? So here, this is the risk of loss. And here there is hope of gain. Right? On expiry, there is a risk of loss and there is a hope of gain. Then, in case we talk about the person who is involved into the short position or short selling of this future, students, then on expiry, what is happening? On expiry, if the prices has gone up, there is a loss because I have sold at 80 and now I'm going to purchase at 90. So there is a loss of 10 rupees. On 1000, it will be 10,000, and 16,000 will be my original amount that I've deposited. Against that, it will be adjusted and I will receive 6,000 back. In case the price has gone down, the person who has given a short selling will be benefited out of this. Reason being, because I have purchased at 80, I will be selling at 70. So there is a 26,000 rupees of gain coming out of here. Clear, students? The second one is around hedging, which is protection against the risk. The entity is already exposed to a risk, right? Okay, so the this part that we have discussed is about the speculation. Speculate means whether it can be higher or lower. Now the second part is around hedging, students. Hedging means that already you are exposed to a risk and you have to protect yourself against that risk. So the risk, if let's say the risk is the risk of prices going up, you will do what? You will take a long position in futures, because if the prices goes up, from the long position you will benefit. If you are exposed to a risk of a price going down, in that case you will take a short position, because if the prices goes down you will be gaining. So the entity is already exposed to a risk. Hedging against that risk by using the futures or forwards is the use of the derivative, students. So here the risk is the risk of, let's say, first of all, if I'm holding the equity shares in the spot market, then what is the risk I'm exposed to? I am exposed to a risk that the prices will go down, because I'm holding an investment in the stock market. If the prices goes down, I will lose. So hedging strategy in futures would be that I will sell the futures, because the moment I sell the future, the prices goes down, I will gain. Had I buy the futures, it's not a correct strategy here, because if I buy the futures again, if the prices goes down, I will lose on the futures also. I will lose on the underlying, I will lose on the futures. So selling the futures is the right strategy if the prices goes down. And if it is a loss or if it is a gain, if there is a loss here, I will gain in the futures market, right? Now, this we would have discussed with an example. If let's say 100 shares are purchased at 300, risk of prices going down, the futures are taken in a short position at let's say 350, because futures will have a different price to the spot market, right? Because the futures will carry a time value of money difference. So this 350, I have actually taken a short position. So the closing price is actually 350 here against, okay, there can be three different cases. So the first one can be, let's say, closing price is 300. Now what will happen? I have purchased at 300, okay, initially in all the cases. Then margin money I have to deposit for entering at 350 rupees for 100 lot size into 20%. Let's assume this is 20%, 7,000. So initially I'll end up paying 37,000 rupees as the overall initial cash outflow. Then sale proceeds, in case the price is 300, I will get back 30,000, right? On the futures, I will gain 50 rupees. Reason being, I have entered at 350. Today, the price is 300. It has gone down. That means I will gain of 50 rupees. And here there will be a gain or loss on future, which is a gain of 5,000. I will get my margin money back, right? So that means I will get 42,000 rupees in my hand. Now, what if the closing price is 350 itself? That means I will realize 35,000, which is at the rate of 350 on the investments that I'm holding. I will also get back 7,000 rupees. There will be no gain loss, and hence my overall earning will be 42,000. In the third scenario, where the price is moving to 400, here I will realize 40,000 rupees, students, which is basis 400. 7,000 will be my margin money, and there will be a loss of 5,000 rupees. there will be a loss of 5,000 rupees, and hence I will receive 42,000. So the future selling price of 350 minus purchase of spot price at 300, this is the 50 rupees gain into 100. This 5,000 is actually leading to me a gain of the above 42 minus 37, which is this 5,000 gain that we are talking about. Clear, students? So long position means contract to buy on expiry. Short position means contract to sell on expiry. And this is exposed to the risk of downside if I'm taking a long position. And short position is exposed to the risk of upside, because tomorrow if the prices increases after I've short sold, then it is going to increase the loss. Clear, students? So let's take a break of 10 minutes, and again let's reconvene at 8:30, students. So the place where we ended up is discussing about the long position and the short position on derivatives, contracts, and futures. How does it looks like? Uh, Now, as a matter of next step, let me first cover the options piece as well, and then we will go to the questions. Yeah, so this is just, I think, a depiction of if A is equal to the P into E raised to the power RT. So if we swap A and P interchangeably, then how does P will look like? So these are some of the questions that we have done in detail in the classes, students. I'm just moving down. I'm just going to some of the relevant piece. Yes. So this one is important, students. So if you see hedging as a concept that we discussed is about taking a decision on one sort of a risk and applying how can we protect against those risks. So for example, X Limited, there is an equity share which is dealt in the spot market, cash market, and there is a long position and there is a short position, right? If I take a long position in equity market, I will have to take a short position in the futures market. So that means I have to take a opposite position in the futures market. That is clear, right? In the previous example also. Then if I take a short position in equity market, then there has to be a long position in the futures market, students. Now, if let's say I have to do a hedging using the index futures, let's say I've invested into an equity share of X Limited and I can sell or buy the index futures, then how I am going to do that? Please do remember that the equity shares of individual companies are actually related through beta to the index futures. So if beta is 1.2, market index is 1, X Limited is 1.2. Here if beta is zero point 0.8, market index is 1, X Limited will be zero point 0.8. So we are talking about the sensitivity of changes in the returns to the sensitivity of changes in the returns in the stock price to that of the market. If there is a same stock, we talk about cash and derivatives. Take always equal and opposite position. That's what the principle is. If we have to do the hedging using the same stock. If we have to do through market index, this is very, very important, students. Then what we are going to do? We are going to take the existing beta minus required beta multiplied by the value of the portfolio divided by the value of futures contract. So we have to bring in the element of beta here to arrive at the number of index futures that we have to sell or buy. Sometimes the question says that you have to reduce, you have to do a complete hedging. That means the beta required will become zero. Okay. Sometimes it is saying that the existing beta is 1.2, they have to bring it down to 1. So that means zero point 0.2 equivalent, they have to hedge. So 1.2 minus 1. So 0.2 multiplied by the market portfolio value will be there to arrive at the value of the futures contract. Clear, students? Then the next one is around equity, which is, let's say we are going a long position in equity, then what position should we hold in the index futures? If beta is positive, students, that means the direction of movement of the share price and the index happens in the same direction. Then if X Limited have taken a long position, index we will take a short position. If X Limited there is a short position, index we will take a long position, students. So then we will take opposite position if beta is positive. Clear? If beta is negative, students, then take similar positions. That means already the negative beta will mean that already your stocks are moving in the opposite direction. So if you have taken a long position in index futures, also you take long position. In case you have taken short position in the spot market, you take a short position in the index futures. Clear? So beta being positive or negative will actually determine the opposite position or the similar position. So now I hope students it is clear that what is the value and extent of value, direction and extent of the index futures that we have to take the position upon. So this is okay. Question number 6 we would have discussed. Now if you see here, we have applied that value of portfolio multiplied by beta divided by the value of the futures contract to arrive at what is the number of Nifty contracts to be sold here. Okay. Then, yes, this is also important. If something is overpriced in the market, let's say there is a land that is there, the land is overvalued and you are holding that land, what you will do? You will sell the land. And if something is underpriced in the market, if let's say land is valued, let's say generally at 1 lakh rupees, but the seller is willing to give you an 80,000 rupees. So what you will do? You will purchase the land. Correct? So whenever anything is overpriced, it is always available for sale. Whenever there is something is underpriced, it is always looked to purchase. Correct? So if futures are overpriced, students, what I am going to do? If futures are overpriced, I'm going to take a short position in market. Because if I take a short position in futures, I will have to take an opposite position in the spot market. And for taking the long position, I will borrow money for taking the long position. Correct? Because taking the long position means I will have to purchase the equity share. Now, the moment I have to purchase the equity share, I will need money. So with this, I am able to do a hedge, and I am able to do a arbitrage wherein I am getting a riskless profit. If future is underpriced, students, then what I'm going to do? I'm going to take a long position in the futures market. If something is underpriced, what I do? I just go and purchase that, right? So if I take a long position in the futures market, effectively it will mean taking a short position in the spot market. Now, whether is this allowed? The answer is no, it is not allowed. So then what I'm going to do? I'm going to borrow one share and sell it in the spot market. Simple. I will, if let's say the delivery of the share has to happen, I will borrow one share and sell it in the spot market. Then what I'm going to do on the expiry, I'm going to purchase the share and return the share back to the person from whom I borrowed it. But in a way, using this strategy, again, I would be able to do a arbitrage gain to the extent of the future which is underpriced compared to the market prices. Clear? Then the next topic is around options, students. Okay. So the options are basically the third type of derivatives. So till now we have discussed within derivatives futures. We have also discussed forwards. Now we are going to discuss about options. Now option students, there are two different types of options. One, there is a call option. Second, there is a put option. Now hear me out very carefully. Again, these topics are being discussed on revisionary basis. The detailed part of it has been covered in the detailed sessions earlier. Okay, now options. There is a call option. Let's take A as an instrument, which is a right, privilege, which is not an obligation, which is not a mandate. No obligation, no mandate. Right to what? To buy. to buy something. What? Actually, this is an underlying asset. We're talking about an underlying asset, which is a X limited equity share or something at a specified price. Okay. This is at a specified price. The price is also fixed at which where we are going to buy it, which is also called as strike price or exercise price at an agreed date or up to an agreed date. That means the timing of this is also defined that at an agreed date it will be bought or up to an agreed date it will be bought. So this is first of all an agreement to buy an underlying asset, okay, at a specified price. In a price is also defined, which is called as strike price, and it can have two different permutations. One, either on an agreed date specifically or up to an agreed date specifically. This is the way it is called as European option or American option. Okay. So A is a right to buy X Limited's equity share priced at the rate of 100 per share on 90th day from today. This is an example. Or A is a right to buy X Limited's equity share priced at 110 per share up to 90th day from today. Okay, so this is any day up to the 90th day. This is exactly on the 90th day. Clear, students? So on 24th of September, right to buy at the rate of 100 on 10th of October. So this is what? This is an European option. Okay. Now on 10th of October, there are different possibilities. Let's say the actual price is 120 and 90. If the actual price is 120, students, I have a right to buy at 100 for which the actual price in the market is 120. Can I say that I have a benefit here? Yes, I have a benefit. I have a right. I will exercise the right. I will purchase at 100 rupees. I will not purchase at the market price of 120. Right? So I have a 20 rupees benefit. The moment price goes to 90. Had this been futures, I have to actually execute at 100 rupees, which is my contractual price instead of 90 rupees. But since this is an option, I have an option either to exercise it or not to exercise it. Since I am the option holder, now how I will make the decision here? I will say that in the open market, I am getting this share at 90 rupees. I have a option to buy at 100 rupees. Should I execute that option? No. I will go in the open market and buy it at 90. So this is the difference. Now here, it's not a right. It will not be exercised and I will not be losing 10 rupees. Had this been futures, I would have lost 10 rupees here. Clear, students? So this is something that has to be seen from the lens of option holder. Option holder means who has the right with him or her, or who is having a long position in the call option. Okay, long position is always referred to the buying position. It's like an insurance. You pay the premium and you also get secured. So here also, for getting this call option, the option holder will pay premium to the option seller. Clear? Now the second case is about the put option, students. So put option is also one of the options. So here what is happening, let's assume B is an instrument. I'm just taking it so as to just differentiate between the call and the put option. So B is a right, it's an option, but it's not an obligation, it's not a mandate. To do what? To sell. Here it is to sell. Call option was to purchase. Put option is to sell. That means I am having a right to sell what? An underlying asset. That will be defined in the contract, right? A specified price. That means an exercise price, strike price, specific price, whatever we want to call it at. Again, with both the options. at an agreed date or up to an agreed date. At an agreed date means only on that date I have an option, which is called as an European option. Up to an agreed date means an American option. That means up to that date, my option is open. I can do whatever I want to do. Whether I want to exercise this, I will exercise this. If not, then I will not. Okay. So this is a put option considering that situation. Okay. Then the next one is around the right to sell at the rate of 100 on 10th of October. So in this case, what will happen? Let's say the actual price on the 10th of October reduces to 80 rupees. Now, please pay attention, students. I have a right to sell at 100 for which the market price is 80. What I'm going to do? I'm going to exercise my right of selling it at 100. So I will be exercising the right here. The second case, which is if let's say the actual price is 120, this is not a right anymore. So what I'm going to do, I'm not going to exercise. Why? Because I have a right to sell at 100 for which the market is already giving me 120 rupees. So I will go in the open market and sell it at 120 rupees. I will not exercise this option. Had this case been of the future, my contracted price was 100. The moment my price became 20, I would have a loss of 20 rupees. Reason being, I cannot decide or opt not to execute. That is only available in the case of an option, which is the present case. Okay? So only option allows you to do so. You have a right. Again, and if you are an option holder, if you're an option seller, the the discussion would be very much different. Now let's come to what are the parties to the options, students. Now, what are the different parties to the options? So, I'm just recapping. We have discussed about the call option. We have discussed about the put option. Now, we are talking about who all are the parties to the options. So, the first one is about the holder or the buyer of the right. The buyer of the right is the one who is actually purchasing the right. In the case of call option, it is right to buy. And the writer or the seller of the option is the one who is selling the right to buy. This actually not to be confused with the buyer of the underlying, and this also we need not confuse with the seller of the underlying, students. The underlying will be bought and sold separately in the cash market. The options are bought and sold separately in the futures and options market, which is the FNO segment. On expiration, the position of the holder of call option will be similar to that of the buyer of the underlying, students. And the position of the seller of the right will be similar to the seller of the underlying, because if right to buy gets executed by the option holder, the other person will have to sell the underlying. Clear? Similarly, if we talk about right to sell, students, right to sell of a holder, right to sell of an equity share or an whatever underlying, the holder is actually buying the right to sell. And here we are selling the right to sell. Always focus that what are we buying or selling? We are only trading here on the right to buy and right to sell, students. Right? So this is a writer. This is an option writer. This is an option holder. And here we're talking about right to sell. Clear? Now, the seller of the underlying or the buyer of the underlying It will depend on the situation. Now, for example, holder of the put option will become seller of the underlying, because if the right to sell gets executed, that person will become the seller of the underlying. If on expiry the options get exercised of the put option, so the writer of the option or the seller of the option will become buyer of the underlying. Clear? Now, Mr. A, who is the holder, and Miss B, who is the writer. So this is how they are correlated. Mr. A will pay premium to Miss B for purchasing a right, and Miss B will sell a right either to buy, which is a call option, or to sell, which is a put option. Mr. A will enter into a privileged situation by paying a premium. Mr. A's loss will be not there, and Miss B will act as an insurance company, wherein, in case there is a loss to the holder, the loss will be made good by the buyer. Clear? Now let's understand this better through an example. Let's say the strike price is 110, the spot price is 100, time period is 3 months, and X Limited's equity share is what we're talking about, and the premium is rupees 10. In case of a call option, which is a right to buy X Limited's equity share after 3 months at the rate of 110 per share, what is that we are going to do? Mr. A, who is the holder, Miss B, who is the writer or the seller, premium to be paid at the rate of 10 rupees, which is cost of giving the right. So Mr. A will pay to Miss B 10 rupees as the premium. Now, if the spot price is 125, 95, and 110, so this is favorable to Mr. A. The answer is yes. So hence it will become in the money. So in the money is the one where the option is in the money. It means that option is giving value to the holder, and the value to the holder will be given once the actual spot price is higher than the strike price. So here the strike price was 110. The spot price is 125. If it is a call option, right? If it is a call option, then the higher price than the strike price will result benefit to the holder. We have discussed above, right? So it is in the money. Second one, if the actual price is lower than the strike price, then what will happen? It is not a right anymore. It is not an option anymore. The holder can go in the open market and purchase at 95. Again, I'm repeating, had this been futures, it has to be executed at 95. But this is not future, this is an option. So hence this becomes a out of the money scenario where the option is not fetching any value to the holder. If it is 110, then holder is neutral, students, right? Whether holder wants to buy it through the option or whether holder wants to buy it through open market, it is called as at the money. When it is in the money, it will be exercised. When it is out of the money, it will not be exercised. When it is at the money, nothing will be taken here. Now, in case of gross settlement, students, gross settlement happens how? 125, 95, and 110. So, Mr. A will pay to Ms. B 110 rupees in this case, nothing here in the subsequent cases, and receive one share, right? Only in the first case. The balance two cases, nothing will happen. In case of a net settlement, students, now net settlement will happen basis the strike price and the spot price. So the spot price was 125, strike price is 110. That means 15 rupees of benefit will come to Mr. A from Miss B. Now this 95 also, 110 minus 95, should I mention this 15 rupees? The answer is no, because this 15 rupees will not be paid by the holder to the buyer, because it's not a futures that we have to honor the commitment. It's only talking about as a option, right? And in case of 110, there is nothing to be done over here. On inception, there is a premium that has been paid, right, respectively, of 10 rupees, and hence the net gain or loss situation will turn out like this 15 rupees income, 10 rupees loss, 5 rupees gain, and in both the situations, whatever premium has been paid, that becomes a sunk cost. Okay. Then we are also talking about the net gain from the B's perspective. So the similar amount, whatever is the gain to A will become loss of B, and whatever loss of A will become gain of B. So this is minus 5, 10, and 10. And hence the receipt of premium will look like as 10, 10, and 10. From B's perspective, the payment on expiry will be 1500, and hence 5, 10, 10 becomes the payment. So from this, in a nutshell, what we are talking about is the loss to the writer is unlimited, right? The gain to the holder is also unlimited, because the moment, let's say in this case, the strike price was 110, the actual price become 200. So the entire 90 rupees becomes loss to the writer and gain to the holder. Clear? The gain to the writer is actually limited to the extent of premium. The maximum gain that a writer can have is equivalent to premium. And the maximum loss that a holder can have is also limited, that is also equivalent to premium. Clear, students? So this is good to understand that what are the natural payoffs, what are the natural payoffs around these line items. So this is about the call option that we have studied. Now let's talk about put option, students. A similar example, in case of a put option, the strike price is 110, the spot price is 100, time period is 3 months. Again, we are talking about an European option, and we are talking about underlying as the X Limited as equity share. Mr. A and Miss B. Mr. A is the holder and Miss B is the writer. Now, what happens on expiry? The spot price can have three different situations: 95, 110, and 125. So, this 95 is the rights to be exercised, which is in the money. Reason being, this is a put option. If the prices goes down, it becomes favorable to execute through the option. If it is 110, there is no change in anyone's life. If it is higher than the spot price is higher than the strike price, then it's not a right anymore. We are talking about put option, because then the person can go in the open market and sell it in the open market. Clear? So from holder's perspective, call option better if the spot price goes up beyond the strike price, right? Put option better if the spot price goes down below the strike price. Clear? So put option, if there is a downward movement expected in prices, then put option always fetches the better result, right? But again, both the options are giving you only an option. These are not an obligations. Okay. Now, students, quickly check. Let's quickly do a check on the options and futures. What are the different differences to understand? So, options have an underlying asset. Yes. Futures also have an underlying asset. There is a time limit for both of them. Futures also comes with a time limit, and options also comes with a time limit. Futures carry a mandate with them. They have to be mandatorily, you know, they have to be mandatorily adjusted for. Options carry a right. If they are beneficial, then these will be adjusted. If these are non-beneficial, then these will not be adjusted. Then right, in this case, the holder is only on the gaining side, subject to the payment of premium. Right? Here, gain or loss, anything can happen in case of futures. There is a concept of strike price in options. There is a concept of future price in futures. Yes, there is an involvement of premium. There is no involvement of premium in futures. Clear? Now let's quickly cover the payoffs, and then we can move to the questions and MCQ, students. So the payoffs first of all is about the strike price and premium 5. So let's assume in all the cases the strike price is 40 rupees and the premium is 5 rupees. We are talking about the payoffs first of all from the point of view of buyer or holder, or we can say long position in case of a call option, students, right? And how does it works? If the spot price is less than 40 rupees, the loss will be subject to the maximum of 5 rupees of premium, right? So if you see this chart, the loss is limited till the time we reach 40. Once we cross 45, that is where the gain starts to come in, and it becomes unlimited with the increase in the prices, right? The second case, students, if we talk about, is for the call seller. The call seller, or we can say taking a short position in the call option, or we can also say the writer of the call option. I'm using different terms because examination or the questions can carry any of such terms. Again, let's assume that the strike price is 40 and the premium is also 5 rupees. Now, in this case, since we are talking from the perspective of the option writer, the gain will be limited to the maximum amount of premium. And the moment share price goes up, right? The moment, if you see, to if we go towards the right, it is going up. The moment it goes up, it will lead to losses for the option writer, as we discussed, right? Because higher the price, it will mean losses for the option writer. So if you see, these are equal and opposites, right? In case of call option buyer, there is a limited loss and unlimited gain. In case of a call writer of the call, there is a limited gain and chances of unlimited loss. Clear? Again, it proves the above conclusion that we have discussed. Now let's come to put options, students. If we talk about put options, then put option, there is a right to sell. What? The strike price of 40 and the premium of 5. There is a holder, long put, or I can say put buyer. Correct? Now, in this case, since we are talking from the point of view of a holder, so the loss again will be limited. But the chart will be from right to left because the gain comes to the option holder once the prices actually goes down. Correct? So higher, the lower the prices, the higher will be the gain. So 35 is the price at which there will be no loss, no gain. If 40 is the strike price, 5 rupees is the premium. So the moment spot price reaches 35, so 5 rupees gain will come from the option execution and minus 5 rupees for premium. So 0 rupees the net gain or loss will be there. Clear? So this is the payoffs chart for the put option right to sell holder. Now the last case in this, students, let's come to the put option seller, or we can say short put or the writer of the put option. Here the strike price is 40, the premium is 5. Correct? So what is going to happen here, students? Now here the gain is limited, right? Till the time the spot price is higher than the strike price, there will be a limited gain equivalent to the premium. And the moment prices comes down, it will lead to a loss. Since this is an option, writer students. Clear? I hope the concepts, the situation is clear. Now, we just want to leave with you a thought that in case of an equity, there is a buyer, there is a seller, right? There is a price point in between, correct? So the buyer is actually paying 100 rupees to acquire something, and the seller is also, sorry, the buyer is paying 100 rupees and seller is realizing the amount. Let's say buyer is quoting a bit of 100, seller is quoting a bit of 120. So let's say both of them agree at 110 a mediated price, and that is the price at which the deal happens. Similarly, in case of future students, there is a buyer of the future, there is a seller of the future, and they will accordingly determine um, through the demand and this cycle of the futures. Now the last is around the options students. So in case of an option, the trading happens basis the premium. This is the only point I was trying to make a difference here, right? Because here it will be the strike price that is defined. The underlying will also be defined. Lot size will be defined. Quantity, quality, timing. Let's say it is for 3 months, 1 month, or whatever it is, it will be defined. The only thing which will not be defined is the premium. So the market forces will sell or buy the options on the premium. Clear? So I think with this, now let's move to the questions. Okay. So let's start with these questions. These are some of the additional questions that have not been covered in the detailed sessions. This is just to facilitate the understanding that we have built during today's session and even the previous sessions. Okay, students, so let's start. Question 1. A chocolate manufacturer requires 500 tons of cocoa after 5 months. Okay. So just understand the question. Let's first try to understand the question first, and then we will come to the some of the discussion points, and then I will do a fair solution to this. So first of all, students, this is a question on. It seems to be a question on commodity, right? Because cocoa is a commodity, and we're talking about a chocolate manufacturer. Obviously, so cocoa would be one of the key ingredients that would be going behind manufacturing the chocolate. They have specified the quantity. They have also specified the time period. Okay. 5 months and 500 tons. What is the market data showing? The market data says spot price is 2,20,000 per ton. 5 months future price is 2,28,000 per ton. So see, they have given you both the prices. What is the current spot price running, which is 2,20,000, 5 months future price. So effectively this 2,28,000 represents the future value of 5 months from now. Correct? If you calculate on 2,20,000, which is the spot price, 5 months future value. So the market is trading this at 2,28,000. After 5 months, there are different scenarios, scenario A and scenario B. The spot price and the equivalent futures price turns out to be 2 lakh 40 and 2 lakh 38,000 respectively. And in second case scenario, it turns out to be 2 lakh 12 and 2 lakh 15,000 respectively. The company enters into long futures contract today. Now, first of all, let's see whether this is justified by the company. The company needs to buy after 5 months. So, buying after 5 months and buying the futures now is almost a similar position, right? So, the action is justified. Had it said that the company needs to sell after 5 months, I'm just putting it on a hypothetical basis, then we would have taken a short position in futures, because on settlement it will be as good as that you are selling the cocoa. In this case, it is as good as that you are buying the cocoa. Required, calculate the effective procurement cost under scenario A. B, calculate effective procurement cost under scenario B. So this, both the situations, we have to calculate the effective procurement cost. By effective procurement cost, what they were trying to say is that what is my net price at which I am going to buy this. Compute basis at the initial date and the settlement date. So they are saying us to calculate the basis. Comment on whether futures achieved the objective of price stabilization. This is very, very important. So it's a very good question. In a way, it is asking us to do step-by-step analysis of what has been the procurement cost, what will be the basis, and whether the overall objective through this has been achieved or not. Because this is a question on hedging, right? We are just trying to hedge it. That's the simpler way to do. Okay. So let's move to the solution, students. Okay, let's move to the solution. Now, first of all, it is given that a chocolate manufacturer requires 500 tons of cocoa after 5 months. Correct? This is what the situation is, and hence what extra have been given to us? Spot price. Today is 2,20,000 per ton, and futures price for 5 months futures trading as on today is 2,28,000 per ton. Here, the position taken is long position, which is also justified in the question. Quantity is 500 tons. Okay. So let's first of all comment on whether the company has taken a right thing or not. Futures position, students, is since the company will buy cocoa in future, it is exposed to price increase risk, correct? And therefore takes a long futures position. Clear? So this actually summarizes that the price risk exposure is that in tomorrow the prices might go up, and hence the company is actually exposed to higher prices increase risk, therefore it takes a long futures position. Okay, then let's talk about scenario A. Okay, now we have to analyze around scenario A. What will happen around scenario A? Prices after 5 months. Okay, so the spot price is 2,40,000. Futures price is 2,38,000. Now, in an ideal scenario, students, this would have been same, because after 5 months, my futures should be as good as spot price, right? Because the time to expire has vanished. But in this case, it is not. There might be some other situation which has led to this. So let's take this as a base. So 240 and 238. Now the cost of purchasing cocoa will be what? 500 tons is what we have to purchase, and the spot price will be 2,40,000, students, because this is the price at which we would be purchasing the cocoa, correct? So 500 tons into 2,40,000 per ton. So this is basis scenario A, spot price. Okay. So if we multiply this, we arrive at 12 crores. Okay. So this is the actual purchase price that will be there for the purchase of cocoa. So this is the actual cash market value will be 12 crores. Now students, can I say that, now what is the question asking? Can I say that this is the effective procurement cost? The question is asking effective procurement cost. Is this a effective procurement cost or is it a gross procurement cost? This is a gross procurement cost, right? Now we have to arrive at the effective procurement cost. Now please also do remember that we have taken a long position in futures at the rate of 2,28,000. How are we going to adjust that? Now let's see whether we have gained or lost on the futures. So this was step one. Now, second step is gain slash loss on futures. Long futures were entered at 2,28,000 per ton and closed at, as per scenario B. Sorry, scenario A. We are at scenario A as of now. Closed at scenario A, which is the futures price of 2,38,000 per ton. Now, I have actually purchased at 2,28,000 and the price has gone up to 238,000. So it's a gain, right? Gain on, because I have taken a long position. In case of a long position, if the prices increases, we tend to gain, right? So gain per ton, gain on futures per ton, 2,38,000 minus 2,28,000, which is actually equal to 10,000 per ton. So what are we saying about total gain, students? 10,000 into 500. So the total gain comes out to rupees 50 lakhs. So the futures gain is equal to 50 lakhs. And hence, we can calculate what is the effective procurement cost. It will be cash market value minus gain from futures. So this is actually 12 crores minus 50 lakhs is equal to 11.50 crores. Effective cost per ton, 11.5 crores divided by 500. So this is actually 2,30,000. Clear? So this is the first scenario in which we have calculated the effective procurement cost. Now, why it is a bit different, or what is the catch in scenario A, or in fact, similar catch will be in scenario B, is that so effectively what happens, the price of the futures at which you enter which is in this case was 2,28,000, it actually becomes your actual execution price also on expiry. But in this case, it didn't, because in this case, the spot price on expiry was different than the futures price on expiry. It can be because of any reason, but since it was different, it had an impact on the effective procurement cost. Had this been 2,40,000 only, had this been 2,40,000 only, then my effective cost would have been 2,28,000 per ton. There would have not been a change. But because there is a 2,000 rupees gap here, that 2,000 rupees got added to the 2,28,000 to make it as 2,30,000. Clear? Now let's come to scenario B. Price after 5 months. And this is the B part, right? So prices after 5 months. Spot prices 2,12,000 and futures prices 2,15,000. Clear? So this is the scenario B that has been given to us. Again, let's repeat those three steps, right? First of all, cost of purchasing cocoa, 500 tons multiplied by 2,12,000 per ton, which is the spot rate as per scenario B. Correct? Because the transaction from the cash market perspective will happen on 2,12,000 per ton. So this actually becomes 10 crore 60 lakhs. 10.60 crores. So this is the cash market cost of 10.60 crores. Okay. Then let's also compute the gain slash loss on futures contract. Okay. Which is actually given by futures price after 5 months minus futures price entered initially. So this actually comes out to be 2,15,000 minus 2,28,000, right? So that means 13,000 negative is the loss per ton. Okay. So this is the loss per ton of 13,000 students. What's my total loss? 13,000 into 500 ton, which is actually 65 lakh rupees. So the futures loss is actually 65 lakh rupees. Clear, students? Then let me come to the third step, which is effective procurement cost. So let's first write the cash market cost plus futures loss. Correct? So here the cash market cost was how much? 10 lakh 60, 10 crore 60 lakhs. Sorry, 10 crores 60 lakhs plus 65 lakhs. Effective cost per ton. Sorry, 11 crore 11 crore 25 lakhs divided by 500 tons. So this becomes 2,25,000 students. Let me pause for a moment so that all of you can understand this. So this is the second part of the question, right? A and B part. So till now we have actually answered that what is my effective procurement cost in both the scenarios, scenario A and scenario B. Now in this case, the situation is quite similar, right? Wherein there was a futures entered and there is a futures gain or loss that is adjusted in the original procurement value to arrive at the effective procurement cost. Clear? Now let's calculate the third part, which is the basis. So the C part, calculation of basis on inception and settlement. So initial basis. So what do we mean basis, students? What do we mean by basis? Basis is basically the difference between the spot price and the futures price, right? So it represents the additional amount on account of interest, maybe because of the time value of money, right? So initial basis is calculated as is equal to spot price minus futures price, which is effectively 2,20,000 minus 2,28,000, which was the initial value, right? So minus 8,000 becomes the initial basis. So this is the initial basis per ton of 8,000 rupees. Okay. So this was the first part. The second part is actually the settlement basis. We will use the same formula again, but here let's do scenario wise. Scenario A first, and then let's go to scenario B. So basis is equal to spot price minus future price. Okay. So what is the spot price? 2,40,000 minus 2,38,000. So 2,000 rupees per ton becomes the basis. So closing basis, or we can say settlement basis, is equal to 2,000 rupees per ton. Then scenario B. Spot price minus futures price, right? This is the closing basis for scenario B now, what we are calculating. So what it was, 2,12,000 minus 2,15,000. So that means minus 3,000 becomes the basis. So closing basis minus 3,000 again per ton. This is as per scenario B. Okay. Clear, students? So till now, we have covered the first, second, and third part, right? First part scenario A, second part scenario B, third part the initial and the closing basis. Okay. Now, let's quickly plot the summary of results. Now comes the main part, right? Which is the fourth part, which I said that it would be a very good conclusion to arrive at. So summary of results, students. If I plot, let's say, scenario A, scenario B, spot purchase cost 12 crores, 10.6 crores, right? If we are saying that in both the scenarios, whatever would have been my cash market cost would have been 12 crore and 10.6 crore. Futures gain slash loss plus 0.50 crore minus 0.65 crores. Correct? Effective cost is 11.50 crore. Correct? Although it is saying plus, but it will be reduced. And it was 11.25 crores, although it says minus, but it will be added. Correct? Because loss will get added to the buying cost. So here if it is 1, 2. So this is 1 minus 2. I hope so this is clear. Okay, then effective cost per ton is 2,30,000 and 2,25,000. Closing basis was plus 2,000. Here it was minus 3,000, right? Now this is the overall summary, students, that we are talking about. Now, impact of basis risk. So this is something that I wanted to discuss, right? Impact of basis risk. Now, what is happening here? Had the basis converged perfectly to zero on maturity. Effectively, it means instead of plus 2,000 and minus 3,000, it could have been zero. Then the effective cost would have been locked close to the original futures price of 2,28,000 per ton. So here what we are saying is that had it converged to zero, the original price of futures would have remained, which is 2,28,000 per ton. However, in scenario A, we know that the basis became plus 2,000. So effectively, you see this 2,28,000 plus 2,000, 230 became the cost, right? And in scenario B, basis become minus 3,000, which is 2,28,000 minus 3,000. It actually became the it actually became the 2,25,000. Now because basis changed from initial minus 8,000, the hedge was not perfect. So this difference is called as the basis risk. Clear? Now, if I may say, the objective of hedging in this case, right, is not to maximize profit but to reduce the price uncertainty. Correct? Price uncertainty got reduced. That can be proved how? So, without hedging, students, yes, so we were here. So, without hedging, what would have been our scenario? Cost would vary between 10.6 crore and 12 crore. This is the original cash market price, right? So you see the range. Range is how much? Range is 1.4 crores. Sorry. And then with hedging, the effective cost varied between 11.25 and 11.5, which is here. Correct? So with hedging, effective cost varied between 11.25 crore and rupees 11.5 crore, which is actually a range of only 0.25 crores. Let me write it completely. Thus, the long futures hedge successfully stabilized, because it was asked in the question, right? How the objective of price stabilization is met. Let me go to the top. Comment on whether futures achieved the objective of price stabilization, right? This is the entire crux of the question. So we are towards the end, and hence we are saying that we have proved it, right? That had we not entered into hedging, the range would have been quite different. It would have been quite wide, 10.6 crore to 12 crore, 1.4 crore. But with hedging, the range is very small here, right? Which is only 0.25, 11.25 and 11.5 crore. So thus the long futures hedge successfully stabilized cocoa procurement cost and substantially reduced price risk despite the existence of basis risk, right? So finally, I am concluding saying that the cocoa manufacturer achieved effective price protection to a long futures hedge, although see we cannot ignore the fact that there is a basis risk also, right? Although basis risk prevented a perfect hedge, right? Which we have proved. Why the perfect hedge was not there, basis risk changed. The procurement cost was substantially stabilized around 2.25 lakhs to 2.30 lakhs per ton compared to unhedged range of 2.12 lakhs to 2.40 lakhs per ton, students. Correct? The unhedged range was how much? Which is the scenario, and scenario B, the spot rates. Correct? And this one is the hedged range of 2.25 lakhs to 2.30 lakhs per ton. I hope this question would have tried to explain the concepts that we have discussed today in the session. So with this, we come towards the end of the today's session. I request C. Ashish sir to help us with the concluding remarks.
Thank you, Devas sir, for enlightening the student in this revisionary session on the topic securitization and derivative. So you have covered up the securitization and you have also studied the derivative. So student
Right.
derivative will be continued in the next class, and along with that we shall take the interest rate risk management. So student in this today's class, of course, Divas sir has taken one of, I think sir you have taken one more new
Only
question.
one question we could complete today. Yes. Yeah.
So
Balance we
student,
will cover in the next session.
okay. The idea is that nowadays, if we see our in a previous attempt, that is attempt of May 2026, the question was somewhat out of box. So our purpose here, just we are making an attempt that you should be, we are making you aware about how the question can come in the examination. So of course, this is only an attempt. It may be we are trying our level best. So of course, I cannot guess what kind of paper will come in May and November 2026 for this, for which these classes are meant. But only the purpose here is to make you aware about the giving you the conceptual knowledge, not a rota learning or a ratification. So sir, of course, actually due to this maintenance portal, student you might be facing the problem because assignments could not be uploaded. And anyhow, don't worry, once the portal maintenance over, we all work will be done. Meanwhile, of course, if you have any query, Divas sir, just share our email id and phone number.
Sure, sir.
So student, if you have any query, you please send us a email to us. Divas sir address the same query in the next class. And if possible, even I can do the same, or even you can contact us over the telephone. So this is our mobile number. This is our contact number 0120. That is STD code of the Noida 3045956. And our email ID is sfm-final@ici.in. So, student, with this, please keep on revising the same and be learning the same. And whatever your doubts, so please discuss with us. Devasa, thank you once again for sparing
Thank you,
your
sir.
precious time and letting the
Thank
student.
you.
So, see you in the sir, next class. Thank you,
Yes,
student.
sir.
Thank
Thank
you.
you.
And have a nice day, sir.
Thank you, sir. Thank you.
Thank you. Ah, yes, session is over.